Alright guys, glad to have you on board again today for that last and 5 out of 5 video on blockchain, which is basically meant to do one thing, to give you guys every required knowledge for you to navigate the next cycle efficiently. Because there's been lots of things to discuss, I have decided to break down that video into 5 underlying subsequences. The 4 previous ones were describing in greater detail some of the models that I will summarize today in kind of a global 5 out of 5, in which I'll also add up some other models that didn't really require that much in-depth review. So I think, as a quick introduction, I will just set the TLDR and the key takeaways on the first 4 videos in here, though of course I strongly recommend you to look at them to get the full detail. Okay, so first one was out of 95 currencies, how to filter out the noise and therefore get the 5% valuable tokens in here. TLDR on the model is that we mostly based our reflection out of this, which means the number one takeaway is most of the time we don't even need a blockchain, and even if we did, most of the time then it's not economically viable, in a sense that basically even though we do get trustlessness and eventually censorship resistance, most of the time we're dealing with area and market shares that don't necessarily require to be so censorship resistant and stuff like that. Because there's one thing that people generally get to flush and don't talk too much about, it is that there is an inherently high cost of rolling over distributed ledger technology and blockchain, and doing it in a public fashion, which means everybody can see the transaction and stuff like that, definitely brings a lot more money to the table required. So on that front, that really means there's no room for everyone. There's no room for 5,000 tokens and stuff like that. When it comes to blockchain, all right, and there are 2 different things. There are blockchains and protocols. We'll talk about that. But when it comes to blockchain, there isn't room to get millions of them or stuff like that, okay? Unless we get to some distributed economical application of it, which is the Cosmos vision. We'll get through this later. Despite that, remember that the core blockchain technology, there can be 10,000 layer ones, altnet layer ones, just don't make any sense, all right? So that's the way it is. Most blockchain application use cases today, and most tokens are either application-specific tokens, which are basically protocol layer stuff, which we've talked about as well, or if they are blockchains, most of the time they don't compensate for the inherent cost of running and keeping up to date that blockchain. All right, so most of the time, most blockchain are just profitless and not profitable at all, though they can just inherently go to zero. It's just a matter of time and capital allocation. Okay, the second video that we've seen is basically explaining where we are now in terms of market cycle and explaining how did we end up there. The thing is that it's hard for people now to figure out the difference between the valuable tokens, the 5%, or it's even less than that actually, and the 95% Ponzi schemes who are inherently going to zero, when everything seems to be going to zero and every token seems to be reacting the same way. Well, the truth is, we're in that bear market in a weird way. It's a combination of 2 factors that we've explained in greater detail in that video. Is that basically the first one is that there has been some very weird type of market participants heading into 2021 that have been buying the dips in 2019, and they've been gambling with customer funds because they were leveraging very hard. So these are the BlockFi's, Celsius's, FTX and the like, who've been basically over leveraging or their way into the market, made some tremendous mistake, and of course, as the market cannot go only way up forever without creating Ponzi schemes, when people were asking for the money, we discovered that there was no money. So that's really the problem. That means the whole crypto has been under like dynamite fuel, because basically some people have been gambling with money that wasn't theirs on top of it. So that's really the thing, that the bull market in 2021 was overstated, overblown because of that speculative money. And on top of it, the second factor was the withdrawal of liquidity in the more institutional market shares, which is basically nothing that is crypto-centric. It's been something that has been happening everywhere in every marketplaces. in the traditional finance as well. And anyway, in here, there was no way to wait but until this withdrawal of liquidity terminates itself. So we're still in. That's also the reason why the bear market we're in is still, for now, going on. Though crypto-specific factors have been washed away and we're ready for another bull market, there is still the moment in which we wait for that liquidity withdrawal to terminate itself. So until then, we're in a conjunctural factor of those two, which means it's hard to distinguish value from noise because everybody seems to be going in the same direction. But still, we can see that some crypto-centric factors have already started to differentiate that. It means some tokens have a bullish shape on the weekly, monthly charts. Some just look like utterly bullshit stuff, which inherently goes to zero, and history has been one of major factors to differentiate these two. Though that really is a key takeaway from 2 out of 5. From 3 out of 5, we've been going on for the accounting model, which is an imperfect but still better than nothing model to follow the guidelines on how we will probably filter out the noise over time during the next cycle. How different model will bring different types of profitability, and key takeaway in here is that not every blockchain or token or anything does have to be profitable. Just need to understand the separation between the three. There are the unprofitable ones, the ones that will run at a loss. These ones definitely have to be limited ones. There are no rooms for this to be 10,000 tokens. They have to serve some public purposes, okay? They're just like hospitals who are there to heal people. They're not here to make profits, and that hasn't been the game. So these are kind of public infrastructure stuff which will run at a cost, and this cost will be shared among those using this network, and therefore there cannot be just as many unprofitable blockchains as there is today, okay? This is venture stuff. Though, despite those public needed public service type of blockchain, which can operate at a loss, and someone will have to jump in to come up for those losses. Remember, somebody has to pay. And generally, that means that the public use of that blockchain means that people will use it at a loss. Concretely, that means you're going to pay for that service and you'll be happy with it. Because what you will take away from that service is going to be at a greater good, aka social medias and stuff like that. Probably tomorrow you'll be ready to pay a few cents on your social media to make sure that this is censorship resistance, decentralized, immutable, and stuff like that. There's going to have to be a cost, an inherent cost for those public services. Of course, you'll be free to have private, free alternatives who will be centralized, censored, and stuff like that. So that's going to be up to you to use those networks or not, but the general expenses of it is probably going to be for the user. Though these blockchains, okay, will operate at a loss, but their users will be ready to pay for it. That's really the way it is. We've seen the second type of economic model for blockchain accounting. It's just basically net non-profitable, which means they're kind of making some profits, but those profits are inherently rolled into the model to either build a free use cases for the users, who basically you are both a user and investor of a protocol, and you're going to get to receive some of the tokens which you will spend by using the protocol itself. And you get like that circle around economy, which is like a collaborative finance system, which means you're investing in the protocols you use to get a free use cases of them, okay? These protocols eventually make some profits and redistribute those profits to those who actually use it. And that's the way you can create circular economy types of stuff. These types of blockchains will have to pay for their inherent cost and stuff like that. And they will probably do it. And the excessive revenue, the net profit, will probably be shared among the network's users to get them a free use case. That's really the way it is. Circular kind of more productive economies for those who profit and participate in those protocols. And the last type, the profitable ones, the very few ones who will be successful enough to generate net positive revenue, and that will be able to generate yields without deteriorating the token's price. These, of course, are very limited places. There will not be endless profitable blockchain, but those who will be able to smartly invest in these, yeah, these ones can be making extra money. Remember, the only way you can make money out of blockchain without participating in it or without using it is those profitable blockchains, okay? So this is for passive investors willing to get money without necessarily doing too much. They can only be doing things like that for profitable blockchains. Okay, if you invest long term in a non-profitable blockchain, you're going to lose it all or get diluted over time. That's really the other way around. Okay, so 3 accounting model for profitability, and really need to understand these. All right, and how you will structure your investment strategies among these. If you invest in a non-profitable blockchain, you better have to use it. Remember that. That's what we've talked about in this one. Okay, 4 out of 5 was the structure model SDN, really important one to understand and separate different layers. There are the infrastructure layer, the protocol layer, and the app chain and the application layer. Remember that in a Cosmos ecosystem, there is kind of a blurry line in here with the app chain thesis, which means we have some application-specific blockchains that run generally one or very few protocols. But don't get me wrong, these ones will specialize over time and they will run multiple protocols. So they will still orchestrate the same way. So it feels like Cosmos is just another subset, kind of another fractal of the same old system, which we can actually see as well in the same stuff as Ethereum in its layer 2. So kind of a very specific factor in here. But the key takeaway from the SDN model is that, well, today everybody is so focused on the application layer, which makes no sense because the maturity stage in which we're in is building maturity of the infrastructure layer. We do have the market competitors who are now starting to specialize, and the final end game stage will be to interconnect them with a generalized standard protocol. And when we'll get that, all of the unuseful blockchain or not specialized enough will die out immediately because the capital will be able to transfer freely. Though that's the next stage we're in, finalizing the competition, the outrageous 2021 competition in the blockchain layer, by figuring out and solving this competition problem in the infrastructure layer by interconnecting them, and we're at that stage. In the protocol era, that means basically we've had this distributed protocol stuff distributing into blockchains that will die. So we've seen that these protocol will concentrate back in as the natural selection will occur in the infrastructure layer. We'll see protocols going back to their original state and starting to specialize as well by creating kind of DAOs, sub-DAOs architecture. And at a later stage, we'll even see sub-DAOs creating sub-DAOs themselves, creating this very complex mesh infrastructure. So like we stated, there is going to be hell a lot of growth and interest in protocol development in the next cycle, because basically that's probably where we're going to see much competition in between protocols to compete for these DAO sub-DAO architectures. So pretty much like the competitions that we've seen in the layer 1 last cycle will occur this cycle in the natural selection and competition in the protocol layer. Very important to see. That's also meaning that we already seen who are the main core protocols that are already winning the battle. These are the Alves, Uniswaps, and the like, who are really key elements and leader in their reference market shares. So these are the likely ones to start seeing the first sub-DAOs organizing themselves as competing existing fork of these protocols will migrate back to the original and start to develop in below this one. So this is what I expect to be very interesting in the next cycle. And of course, forget about the application. It will come at a later stage. I'm still expecting full adoption and use cases to mature out of 2030. So that still means we got hell a lot of years ahead until we get to real day-to-day use cases of decentralized application. Until then, boys, we're still building the stuff, and there is an order of which these things can happen. This can't be random, all right? So the style we're in and the maturity we're in is interconnecting those blockchains, which will filter out the bad ones or the competition out of this system to enter collaboration, which means those blockchains will start to cooperate and specialize. Same thing will happen as it was in 2021 at the protocol layer. You will see hell a lot of competition on blockchains, on protocols in here. Most of them will solve this problem with creating inherently complex governance structures. All right, so that's we've seen. We'll of course see new protocols emerging out of new specialized blockchains creating out of nowhere and stuff like that. Okay, and we'll see competition between those protocols and stuff like that. Okay, just like we've seen competition between layer 1s and out layer 1s, we'll see hell a lot of competition between new protocols and existing protocols. Okay. I expect the same thing as the Ethereum killer to exist for Aave killers and stuff like that. They will probably all fail, just like they did for later ones. Okay, so that's it for the maturity. Really, really important takeaway so far. Now I'm going to add some other models to spice up that mix. Okay, so you're familiar with this one, you're familiar with the SDN. We remember this one, very important one. I've mentioned it multiple times in the past, the adoption cycles, and due to the fact that there are multiple layers in this ecosystem, okay, we are merging with traditional finance. Remember that blockchain is a revolution, and revolution don't just throw everything away and replace stuff. Okay, this is really the way it is. We hybridize with the existing financial system, so we generally will, consciously or not, copy and mimic some of the inherent organization of the financial systems. So financial systems always had kind of the inherent structure. There have been multiple things, but all the time we see and create a store of value which will install its value over time. They generally have very long adoption cycles. And we clearly can see that with Bitcoin and its long 4-year cycle halving stuff. Okay, nothing can destroy Bitcoin. Each and every halving cycle creates all-time highs. And basically, as we mature and mature, it takes more capital to bring it up. So it will kind of be topish. So it's not going to go to 2 millions or whatever, but it's going to slowly keep its adoption. It's inevitably there and not going to be killed. What we like out of this is just like what we get to gold. Sometimes in the economic cycle, there will be demand for gold, but most of the time, gold is not that demanded. It's just there as an ultimate safety. It's required because no financial system can run if there is no exit door. So Bitcoin is the exit door for the rest of the crypto financial system. All right. Then comes the credit market, which basically means every economy needs to have future spendings or spendings for future wealth, which is basically the way you can create value without necessarily having the capital today. That means there is a risk factor in here. There is debt in the system, and this debt needs to have a reference debt collateral, a very, very enormous liquidity type of asset, very, very demanded, okay? And basically, the more demanded, the lower the yield. This is exactly what we see with Ethereum. So I'm not going to go over this. I'll let you guys read that one. But very important takeaway in here is that, well, I think at the stage we're in, Bitcoin has definitely been solidified as the store of value in the crypto ecosystem. There's no one to compete with that. Ethereum has been settled as the standard debt collateral, which means, well, if somebody takes too much risk, yeah, I'd rather like to take its Ethereum. So if I can take someone's Ethereum because he's been taking too much risk, I'm really willing to do this. So that's really the way it is. It's kind of the safe collateral. You can get a yield out of this, okay, and you can get a low risk yield. That's kind of staking ETH. I mean, you really want to be the dumbest out there if you really end up being sloshed by an ETH being an ETH validator. It's really simple to validate. You're participating in a network and stuff like that. Okay, so this is definitely getting itself very in line with the debt collateral. The thing that we're in is that I think cycle over cycle, we're getting to mature through this mimicking the financial system. So we clearly seen Bitcoin taking the lead on the store of value stuff. It's been happening for years, and as time passes, it just does nothing but solidifying that stance of a store of value, which is whenever Ethereum or others will find their rough limit, there have been misallocated capital out there, you will have the option to sell your ETH to go back to Bitcoin. And that will be the sign that we're in the end of a debt cycle, just like we have debt cycle in our economies. Okay, remember, we need debt. We just need debt to be profitably allocated to get growth. And when the debt is misallocated and when growth is sold but not delivered, this is where you want to have this option to fly back to safety. Though once again, we need that, but we need that as well to get a good allocation of this. Okay, the safety belt is required in the car, but the car doesn't move on if it doesn't have fuel. Okay, kind of a good analogy here. The money multipliers is like the replication of investment bank strategies, which is the equivalent of fractional reserve investment, which is basically we're going to use the reference token in here, though this for an investment bank is just savings deposited in the bank that will be using those those savings in a perspective of providing a yield. But the yield is correlated to the default risk, which is basically we're going to lend out money to enterprise grades and value creators, and the goal in here will be to extract a portion of that created value. By offering access to capital to leverage future wealth creation, you're gonna just take a bit of the created wealth out of the system to reward those who've been taking the risk. So in here, you have a totally different allocation. This is a yield correlated to default risk in here. So these are the money multipliers kinds of things, okay? So that's really the way it is. And they are competing with each other to find the best suitable investment for the money deposited. So that's really the way it is. And we've seen, to me, that the last cycle without layer 1 and layer 2 scaling solutions, they're all are to me in this same bucket. They have their inherent tokens. Their tokens most of the time have an underlying ecosystem that we can see layer 2s have an inherent ecosystem. Cosmos has its own ecosystem. Atom being kind of the bank of Cosmos. Polkadot, dot being kind of the bank allocation for block space on the Polkadot ecosystem. Solana's trying to build its ecosystem with huge incentives and TPS and stuff like that. Avalanche is trying to build its ecosystem with its subnet architectures and stuff like that. So as you can see, there are multiple options in here. Layer 2s do compete with these ones as well. As you can see, the optimisms with the OP stack. You can see the stock stuff and whatever. They're all trying to give away a tech stack for sub-layer adoption. These are definitely these kinds of things that will incentivize use cases for applications who will create value to deploy on their underlying ecosystem so that they can take a bit of their revenue as a feedback loop. So that's really the way it is. As you can see, these are the ways money flow into today's traditional financial system. And as you can see, it's very, very funny to see that the crypto has followed suit. So I think the next cycle that we're headed to is the specialization of these, which means it's really fight for survival. These guys cannot all survive. There is not enough adoption to go for every of these market participants. These will concentrate. The adoption will follow the same old adoption rules of Pareto cycles, which means most of the time, 80% of the demand will be into 20% of the actors, which means there will be just very few of these inherently taking a hell of a lot more of the underlying demand. Most of the protocols will deploy under some specific umbrellas. And these ones will be able to extract value and therefore create profitable models. Okay, remember that. These are like investment bank. They can lose a bit of money in the early stages, but they're gonna have to be profitable in the end. Otherwise, it's a net lose game, and whoever has been investing in will lose it all. Okay, that's really the way it is. If capital is well allocated, there will be leverage systems that will inherently make it profitable, and these are like economic cycle related. Okay, we'll talk about cycle, very important stuff. All right, and then comes the value creators, aka the protocols or applications which will get in interactions with the consumers, will basically be there to create network effects and stuff like that. Okay, they will create the revenues and stuff like that, and some of those revenues will flow back to those who've been lending money in the first place. Those who've been lending money in the first place, when they do not have enough money to lend, or when they have been poorly allocated capital, what happens? Generally, people tend to sell the shares they have in a bank back for some more safer places like a government bond. Okay, that's really the way it is. That's how money circulates in an economy. And when the government bond itself doesn't provide enough compensation for the risk taken, people get to buy gold. And as you can see, that's exactly the way financial system works today. So the thing that we are in means this just destroys the narrative in which there's one crypto market. There are no one crypto markets. There's no one Bitcoin and ETH. Bitcoin and ETH are two totally different things, and they do serve different allocation at different times of the economic cycle. Okay, just like the money multipliers do serve several use cases that are absolutely required in a healthy financial system, as long as the risk they take are well distributed. When they're badly distributed, that means these tokens will go to zero. That's really the way it is, and there will be a natural selection because there's not infinite amount of money to be taken from the consumers. That's really the way it is. Just like out of protocols, out of 100 protocols, there are probably going to be just 5 of them surviving the end of the next cycle. We've said there will be a lot of value created in here, probably with a lot of debt, and only the good allocated debt will be able to flow back revenue to the original holders. Otherwise, it's really not going to be that simple. It's not just money being created out of nowhere. The fractional reserve investment is always like that. It can be profitable, but if too many people try to exit and there's not underlying profits being made, it goes to zero. So bear that in mind. There are unprofitable models in here and some will die. Okay, that's really the way it is. There will be a lot of bubbling creation in here, but out of the hundreds, there are really more than 95 who are absolutely inherently going to zero, and you're rather not to stay too long in those areas. There are some protocols who are solidified enough to know that they were creating value, just like enterprises will be profitable. To me, they are the ones like the AVEs, the Uniswaps, and the like. We know they will be able to generate more revenues than the inherent cost of maintaining and updating the protocol. But these should turn out to be selected through the next cycle. So I think throughout the next cycle, we'll be having natural selection for investment banks. Some will survive. Most will survive, but the adoption will concentrate due to Pareto laws. Remember that they will probably, I think, half of them will die. The remaining half will compete for market shares that will be very unevenly distributed to a major participants and then fewer competitors, okay? The government bonds, well, there's no competition out there. Sorry, guys, it's ETH, and it's been solidifying its role in the past cycle and will probably just confirm that role in the next. Bitcoin, well, it's been solidified for long enough. There's nothing to be competed about, okay? Though enterprise, I expect them to start be profitable. So I'd like to see the first protocols starting to be profitable, building their underlying DAOs and sub-DAOs below them, okay? Remember that in here, we've got different economical models. Some will run for a profit and will distribute the profits to token holders. Some will inherently reinvest the profits at the benefits of their users, okay? So we'll see those different economic models compete and to see which ones succeed over time. All right, so that's the stage we're in. I've mentioned the risk cycle. Even though this one would require another 20-minute video on its own, I'll go quickly on this one to experience that, to say you've got generally kind of a fashion in economics, which will relate to the Feigenbaum's model. In here, just to mention that as the logistic map tends to mature, so this is weird stuff, very interesting video about that on YouTube, but TLDR in here is that this is how chaotic systems tend to orchestrate themselves throughout a inherent organization. What this thing tells, and the story that this thing tells with a very, very beautiful manner, is two things. First of all, the fractal relationship of things, which means depending on how much you zoom, you will see the same system repeating itself somehow, some way. That means there's some way of order into chaos. If you were to zoom into this area, what you would see is just that in a zoomed version. So this really that fractal ecosystem stuff. And the second thing that's very important to take away out of Feigenbaum's distribution logistic map, which is the fact that, well, as you can see, there are those bifurcation diagrams in here, and 1 goes to 2, and then 2 goes to 4, and so on. And then you get to chaos, which means, first of all, it seems organized, and then it gets chaotic. I think we've really started to go into the chaotic phase. There are multiple blockchains, tokens out there will lost. It's really complicated. Most of them will die and so on. The thing is that, as you can see, the key takeaway is that at some points in time, you go out of chaotic periods like that, which means you're in areas like that. It's absolutely unpredictable. Just try to tell me where the next dot is going to be, and there's no way you can give a rational answer. You just know it's going to be chaotic, all right? The distribution is inherently unpredictable. Due to the inherent factors of complexity that makes it absolutely unpredictable. But what this diagram tells us is that, well, at some point in time, as you increase the rho value, you still get to find some order in chaos, some kind of isolated island in which the pattern goes to structure itself, this fractal stuff, okay? Remember, when you zoom in here, what you see is exactly the same bifurcation diagram, okay? But the thing is that, for whatever reason, at some point, this chaos structures itself back into resonators, okay? And these resonators is just like I would make this this parallel in the financial system between chaos and value. Remember that value isn't everywhere. The value is concentrated on a few assets. And when we've taken too much risk, there is kind of a natural order in chaos, which brings back to a more stable state. The money will kind of concentrate back into the safer assets where there are inherent value, and then the value gets distributed again following the same old fractal toward chaos. So in that system, what matters is to understand the cyclicity of these things. This is not all random. They are attractors. There is inherent chaos most of the time, though people try to give rational out of chaos, and that's utterly stupid. But there isn't just chaos out there. It's really important to understand the chaos theory and this attractor kind of theory when it comes to the logistic map and stuff like that. Remember that in financial markets, this would be related to value. We know that exists because otherwise people like Warren Buffett's and the like wouldn't exist. We wouldn't have successful lifetime investors and stuff like that who are actually being able to capture value, to figure out that despite the inherent environmental chaos, there are some money attractors. So that's really one thing to take away. When it comes to this, well, there is a beauty of this, the Feigenbaum actually expresses it, is that there's a cyclicity, okay? It's not just random, there is a way of putting this thing into order. It's not all just random. And out of this, there is a natural tend to say that if we take out what we said before, that there is long-term cycle for kind of store of value, and then kind of shorter cycle for debts, and then even shorter cycles for yield, for economic cycles, and economic cycle, okay? There's these kind of safety cycle, debt cycle, investment cycle, and economic cycle, okay? We've seen that, and if we put it out into some kind of a diagram like that, very simplified, you would see those longer-term safer bets, then the debt cycle, each divided by some economic cycle, okay? And if you, or investment cycle, and if you figure that one out, well, you would see, well, taking this model out would say, well, in terms of the lifespan of crypto, if that was time on the axis, we would have been the best investment in the early stage is to go for the safest place. Is to basically, that's also the reason why most of the money was put into Bitcoin in the early stages. It was kind of the smartest way to invest. There's still some portions in which money would be smartly invested into the economy, okay, the investment cycle. And what you can see in here is that as the ecosystem matures, and as we are today, there is the emergence of very, very good money allocated to the debt cycle, or kind of the in-between cycle, the mid-cycle. Call it long-term cycle, mid-term cycle, short-term cycle, okay? Safety cycle, debt cycle, investment cycle. And in that matter, you would see that as cycle passes, today we would kind of be there. This is the moment in which the investment cycle will likely be the best strategical investment, okay? So what you could take away from this is that, well, investing into Bitcoin was definitely the smartest thing to do in the early stages, will still be at some point in time, but not necessarily the smartest investment of all, okay? The thing is that right now, it's investing more heavily into the investment cycle, okay? Knowing that the next big stage will be investing right back into the debt cycle, okay? So at the beginning of the cycle, you go for the debt cycle. At the maturity stages, you go with the investment cycles, okay? And if you understand that, you kind of have a model of capital allocation over time. Okay, early stages of crypto, yeah, stay crypto friendly, go for Bitcoin, don't take too much risk. As it matures and as you kind of figure out what the government bond is, go for the government bond. Where I think we're in now is this cycle, okay? I think we're in here or probably in there halfway through the overall maturity of crypto, which means this is a very, very long-term cycle, okay? Remember, we're in this for probably 20, 30 years of adoption. This is the longer term cycle adoptions of crypto led by Bitcoin. And it will take a lot more than just the 3-year, 4-year halving cycles, okay? And the debt cycle in here will probably be linked with the debt cycle in the financial system in the TradFi, okay? So these are like 10-year cycle, okay? And these economic cycle are pretty much tied to the actual investment cycle in the real economy as well. These generally tend to last 3.5 years or so. So that's really the way it is, okay? You've got 3 years sub-cycle, 10 years or more or less debt cycle in an overall kind of 30 to 50 years debt cycle, store of value cycle, okay? So that kind of makes sense. And in that sense, well, we're past the early stages in which going for safety is the smartest choice to make in terms of capital allocation. But now we're in a stage in which it gets more and more interesting to invest into the money multipliers, okay? AKA the investment banks replicated in cryptos, the alt layer 1s and layer 2s. So if you get it right, the stage we're in terms of maturity is that right now we will be smart enough to be in between those two as mostly invested stuff. Of course, in here, not financial advice. It depends on how much your risk appetite is in financial investment. Basically, the riskier your profile is, you know that you will add more allocation into the money multiplier and eventually venture into the enterprise grade layer, okay? You would eventually consider it that way. But you also need to understand that as the cycle passes, you were gonna have to get back to the debt collateral, and at the end of the game, out of debt collateral back into the safer asset, okay? That's really the way it is. Money will flow away depending on the maturity of the cycle. And if we can get it all, well, I think you know everything there is to know into this thing, okay? It's not just random. There is a lot of inherent chaos out there due to the horizontal multiplicity and the endless replication of open source technology that basically is there to distract you from the original stuff, okay? Don't try to give sense to chaos. Just try to figure out what the attractor is. And once you figured out the attractor, you would also figure out that over time in this Feigenbaum distribution stuff, okay, there will be different number of attractors, okay? That's the final takeaway in here. If you look at it in here, you would go back down to 3, 4, 5 attractors, okay? While the next cycle, there's just 3 of them. So depending on how much mature you are, there will be different types of attractors. And that's what we describe with the risk cycle, okay? At some point, you want to get back to both the debt, collateral, and the safer asset. Some other times, you just don't want to, okay? That's the allocation that I give you in here. I will require an entire video about that. But just the LDR in here is that this is kind of the risk curve. There's generally a trend toward risk taking as the cycle mature. People will invest more and more into the short-term cycles, okay? I'll eventually consider a video on this one on its own, but the key takeaway in here is really that. As we are halfway through the maturity, remember that this is the longer term kind of vision for crypto. There are multiple sub-cycles, okay? Remember that each and every sub-layer has its own adoption cycle fueled by a peak of hype, and then there is an S-curve breakthrough in their inherent sector, and then there is adoption of this sector coming along the way, okay? This is the process that operates the natural selection. Right now, the chasm is where we're in for investment banks, okay? All of these I've kind of pumped last year and last year's. They have been destroyed entirely, and now some of them are going to wake up because of their technological breakthrough and following adoption, okay? There's no room for everyone to S-curve. Only a few will, and this will fuel Pareto type of distributions, which means this is really network effect type of adoption. The people will go for the same thing. They will not distribute evenly in between the different participants. There will be network effects, okay? If you take that one and if you create the glue, you would definitely understand where we are. We're in the chasm here for these guys. We're past the chasm for Ethereum. There's nothing but breakthrough and adoption for this debt cycle, okay? We're definitely past the chasm of Bitcoin. Everyone knows Bitcoin is already there. Everyone knows Bitcoin is here to stay. We don't expect technological breakthrough. The store of value doesn't have to be performant, okay? Though remember, we're just there for Bitcoin, all right? So that's really the way it is. Bitcoin is just getting adopted today. It's far beyond the chasm. Pragmatists know that Bitcoin is here to stay. It's not a bubble. Of course, there's still social medias letting you to believe that it is, but there are far less people trying to keep believing that narrative. Now everyone figures out Bitcoin is here to stay, and they will inherently over time, slowly, because Bitcoin's adoption cycle is much longer than the others, all right? It takes far longer for Bitcoin's adoption to fulfill its prophecy. The debt cycle is more mature. And like I said, I think Ethereum has taken that spot. It's probably going to be the only one. There must be, and there will eventually be some competitors, but same thing. Pareto laws means there will be very less room for others to compete in that government bond kind of replicated system. Investment bank, there will be more, okay? As you can see, there is a fractal. I think there will be only one Bitcoin. There will probably be only one Ethereum, eventually up to a couple, but like as well, most of the money will be in one, okay? Just like the most liquid bond market is the US bond market. There are others, but they are far less liquid, okay? As you can see, multipliers, the investment bank, there are many of them, but most of the money is distributed pretty unevenly, following the same old Pareto distribution rules, okay? Value creators are like just the micro economy. It's like the real value creators. Some will succeed being and bringing a profitable model, most will fail. We know that most companies are created and die within the next 2 to 3 years cycle, and that's exactly how it will be for these protocols or app chains and stuff like that, okay? So this is where capital will be allocated from the investment bank. The good capital will take some revenue back to the source. The poorly allocated capital will destroy value for the original investment bank, and so on, okay? And the investment bank investors, when they see that there's too much bad allocated capital, they will get out and back to safety, okay? So if you figure that one out, there's one other thing you can take away, okay? Does it make sense to look at Atom Bitcoin chart, for example? or AVAX Bitcoin chart. No, it doesn't make sense. Look at AVAX ETH, look at Ethereum, you look at Atom ETH, and you would see if some of the safe ETH capital is invested in Atom. That would be the sign that some ETH investors see some potential good allocation in Atom or Polkadot or AVAX and the like. So that makes sense. Okay, guys, look at these guys versus Ethereum. Ethereum is their low risk referential. Bitcoin, what the fuck is the link between the two? There is one to pay real attention to, is that this one. If ETH starts to underperform Bitcoin, that's the sign of huge maturity in the cycle and that people don't see enough capital risk-reward ratios to be made with the collateral. In that sense, they will just sell this one and go back there. That's generally, in our financial system, the end of macro cycles, in which we go back to gold or stuff like that. Okay? That's really important for you to understand that. Now, if you can take it all out, well, now you know everything there is to know about crypto and blockchain. You know where the value is. You know how the value is distributed over time, following kind of those logistic map stuff. Most of the time it's chaos and people just end up misallocating their capital in between the thing, trying to figure out the next 200x. Well, you can do it, but like I said, this is really, really difficult thing to do. And the more time you pass, the more the chaos will structure itself back into order. And you'd rather like to be in those attractors, those who do have inherent value, okay? And understand that thing also about cyclicity and inherent interlast kind of system in which it isn't random. There is order in chaos. It just takes time for it to filter out. And it's really, really the key takeaway in here. If you figure out the valuable protocols, okay, the lower you go into this curve in here, the more short-lived these things are, because they're tied to economic cycle, investment cycle, debt cycle, and so on, okay? The longer cycle are the easiest ones to play, because they're the less susceptible of noise, of short-term noise. It also takes longer for them to pull out their value. So once again, yeah, Bitcoin will definitely do all-time highs again. The matter is, well, it may take 10 years, and that wouldn't nearly be a problem. Until then, Ethereum are very likely going to have to go all-time highs between those 10 years because the debt cycles are much shorter than the ultimate safety cycle, okay? Investment cycle means the good tokens in here, they do have to go all-time high before the end of this cycle, which is expected to be mid-next year. So somewhere around late 2025 or so. If these guys haven't gone all-time highs again, that means, well, they probably failed a natural selection event. Okay, that means those who are invested in this will go away back into ETH, all right? That's really the way to go, okay? Same thing goes for venture capitalists to go for protocol development and stuff like that. If you don't really use those tokens, remember that. If you use those protocols, you'd rather like to be a part of the economic system of either redistributing or public good participation. If you do profit from these protocols, yeah, hold those tokens. But at the end of the economic cycle, get the hell out, back into these guys or back into this one. But that's really how it goes, okay? Cycle and money moves along the risk factors. As the maturity moves, the market tends toward risk taking. That's also the reason why you might not want to play the safe card now. I see so many people saying, yeah, okay, it's getting too complex, it's too chaotic, I'd rather like to go Bitcoin only. I definitely think I've proven exactly otherwise. So the thing is, you want to go toward risks, but you want to understand the inherent cyclicity. As you go for kind of value creators type of investment stuff, it's really venture. So the risk is pretty damn high. You really don't want to allocate all your capital to just a few, because you're going to have to distribute that capital to many to have successful chances of finding the good ones and filter out the bad ones out of it. Okay? That's really the way it is. And the second thing is that you can't stay very long into those investments. You're gonna have to understand that this is money going in, but going back out later, okay? It's really the way it is. Because in bear markets, you don't really want to be the one holding the bag unless you have a clear use of that protocol, okay? So that's really the way it is. Now, I think you got it all. Either you are a user investor or just a pure investor, you should know where we are on the investment cycle, what to go for on the next cycle, how long you expect these investments to last, what you do with it afterwards, and so on. Okay, understand that this is not just a simple cursor to say, yeah, okay, I'm going to put all my money in this or all my money in this. No, it's a bit in here, some there, and some there. Like I've always said, it depends on your risk appetite and your personal profile. I've always said mine is mine and you shouldn't copy and stuff like that. But my risk profile currently says I definitely want to have some Bitcoin. because I play the longer term adoption stuff, and the Bitcoin that I have is the Bitcoin that I'll never sell. Remember that. The Bitcoin that I have, I'm going to go all the way through this. But do I want, at the current stage of maturity, I think we're in, somewhere in there, okay? I don't necessarily, or somewhere in there, I think we're here. Do I want to go Bitcoin full? No, I don't think so. Okay, I think Ethereum has been past its first cycle. It's headed for the next one, if not already. I think 2021 might actually have been the beginning of that cycle. So I think now we could be there. And if that's the case, then I want to be invested into the investment bank sector, but also with this. If you take on the risk factor, we would be there today. Okay, that's exactly my current investment scheme. Okay, I do have some safe haven. I do have some mid-term allocation, and I do have some short-term economic investment type stuff. That's exactly how my portfolio is today. I have 15% Bitcoin, 40% Ethereum, and I do have the rest in more speculative investment. And if you figure that out, I'm exactly in sync with this model. So many people have been asking why that much or why that. That's exactly why. I'm following this investment mechanic. So if you guys need more in-depth vision of these things, because it can be a bit complicated, I'll eventually consider kind of a 6 out of 5 video to compensate for the relative complexity of that model, but I think you can take it away, okay? So that's really the way it is. I'm done with all the models. I've explained everything, how capital should be allocated over time, how my capital will be allocated more and more toward risk-taking in the future, until in the end, of course, it will all go back to safety. Okay, so there will be a time in my portfolio where it'll be Bitcoin only, but that's definitely not now. I hope you do understand this. Of course, these are just models. I could be wrong. I don't know the future no more than anyone else out there. The reason is the difference that I have with most people is that I have models, modeling my decisions so that they're not random, they're not chaotic. I do make well-organized stuff. I could be wrong on some, but I can hardly be wrong everywhere. And that's the reason why I am more of a successful trader than the general foes out there, because I have models. That's really the way it is. That doesn't make me a genius. That doesn't make me a 100% successful trader. It just makes me a better than average. And that, I hope, is what you'll take away from that video. So that being said, guys, that doesn't mean you have to take away all my models and just blindly copy. That just means you have the granularity level of how a professional gets to well-craft its thinking process. I hope you will get this similar level of granularity, either by picking some of my models or mix and blending with some of your existing ones. But that's the level of granularity you should head to. Remember that if you're below average or just average trader, you'll end up either losing money or not really making some. If you're above average, that's how money can be profitable for you. Hope you will take that one away, guys. Bye.